Hey guys, so this is going to be the ultimate course on investing in the stock market as a teenager, so I highly recommend watching it from beginning to end. We're going to be covering UGMA versus UTMA accounts, how investing $50 a month could turn you into a millionaire, as well as a step-by-step process of opening a custodial account. Lastly, I did want to mention that there is nothing for you to click here. There's no sponsor, no affiliate, no pitch. This is what I call 100% straight value, so let's dive right in. So at this point, I want to talk about the two ways that you can make money investing in the stock market. Number one is the most common one that people are familiar with, which is asset appreciation. And then the second way you make money from the stock market is by earning dividends. Now, asset appreciation is the classic buy low, sell high strategy. So if we're looking at a chart, for example, and then you have a stock which goes up and down, up and down, up and down like that, for example, and then you were somebody who was looking to invest in that stock or fund, you would want to buy it low and then sell it for a higher price at a later date. Now, this chart here implies timing the market, which is a losing strategy. It's also nearly impossible to do on a routine basis, but this is just for a simple example of how you make money with the stock market. So let's say down here, you bought 100 shares of this particular stock at $10 a share. And then let's say at the top here, you ended up selling those 100 shares at $25 per share. Well, that means you would have invested $1,000 as your original investment and afterwards sold it for $2,500. That is called asset appreciation, and you make money buying something at a lower price and selling it at a higher price. But what I'm going to be showing you going forward is passive long-term investing, which doesn't really imply that you're selling. Instead, you're just buying over time at routine intervals, and you really wouldn't be selling until you're looking to use that money for a major purchase. Maybe it's a car, maybe it's college, or maybe you're investing for your retirement and looking to just take advantage of that compound interest. Dividends, on the other hand, are optional payments that some companies elect to make most often on a quarterly basis. And this is a method of sharing a portion of their earnings with the shareholders. You end up having this distinction of growth stocks versus these income stocks, and there are some that fit in between, but there's a pretty clear line between these companies that are focused on growing as fast as possible versus paying out dividends and paying these out on a routine basis and also growing those over time. You will find dividends with funds as well. For example, we're going to look at the S&P 500 index fund, or ETF, which does pay a dividend. So you do want to be familiar with how these factor in, as it's an additional way that you can make money with the stock market. Let's say, for example, you have a $10,000 investment and that is earning a 2% dividend yield. An example of this could be an ETF or exchange traded fund where you have a 2% yield, and that means on that $10,000 you would be earning $200 per year in the form of dividends. But like we said, this is most often on a quarterly basis. So instead of being one lump sum payment, you would end up having 4 of these $50 payments throughout the year on a quarterly basis or every 3 months. Now, if you're looking to maximize your rate of return, you're going to want to take your dividends and then reinvest it back into the original asset. And this allows those dividends to then appreciate in value further over time and also earn future dividends. Before we talk about the stock market, let's talk about what is a stock. And the best example for this is to think of a pizza or a pie. A stock is a slice of a particular company, and this means that you are a part owner of that company. We're going to take this simple pie here and break this up into 4 pieces. So for example, if this was a publicly traded company, let's call this company Y. And then if we have our shares here of 1, 2, 3, 4, that would mean there were 4 shares of this company and each person owned an equal amount of it if every person owned 1 share. But with the stock market, there's instead millions or billions of these shares, meaning that everybody has a little tiny slice. It's going to be much smaller than what we're drawing here, but every single share is a little piece of the pie or the pizza of that particular company. And it works the same way for funds that trade on the stock market, exchange traded funds that we're going to talk about later, where you simply have a little slice of that, just like you own a little slice of a stock. Now, we have the stock market for a myriad of different reasons, but two things that it's good at is allowing businesses to raise money and also allowing average people to build wealth over time. We're going to cover the wealth building part later, but for now, I just want to briefly mention the IPO, or the initial public offering. The IPO is the first time that a private company trades on public exchanges, and this often coincides with them issuing new shares as a way of raising money to grow the business. Now, in my full video on the stock market for beginners, we talk about how IPOs are not something that you want to invest in. Be sure to check out my full video in the corner at the end of this one to get the full details. Now that we've covered what is a stock, as well as how to make money with investing in the stock market, I now want to show you a simple strategy that any teenager can follow to become a millionaire with just 50 bucks a month. This right here is a compound interest calculator, and I highly recommend checking this out yourself. It's on investor.gov, where you can simply Google compound interest calculator. And if you've never messed around with one of these yourself, this is going to be a requirement from me. I'm telling you, open this up and play around with it as we're talking about it, or at the end of this video, and you're going to be absolutely mesmerized by what you're seeing. But we're going to go through an example together right now. Now, a lot of people think that you need to follow a complicated strategy in order to make money in the stock market, but that's actually not true. In fact, it's the exact opposite. Following a complicated strategy is often a good way to lose money in the stock market. So what I'm going to show you instead is the recommended approach from one of the greatest investors of all time, Warren Buffett himself. Warren Buffett placed this bet against hedge funds, saying that the S&P 500, which is simply the 500 largest publicly traded US companies over a 10-year period, would outperform or beat them in terms of their more active stock picking strategy. After the 10-year period, the portfolio of the 5 hedge funds ended up having a return of 36.3% net of fees. Meanwhile, the S&P 500 returned 125.8%. So if you invested in the S&P 500 during that time frame, you would have more than doubled your money. But if you left your money in the hands of the professional stock pickers, you would have had a very small return compared to just simply plopping your money into the market. So do not think that you need to or should follow a stock picking strategy. Instead, passively investing in index funds is the best approach, and Warren Buffett even says this himself. And right here, Warren Buffett mentions that both large and small investors should stick with low-cost index funds. And you can own, for example, the S&P 500 in that manner, just owning a little slice of the 500 largest companies. That's the strategy that's recommended. That's what I'm going to be showing you going forward. But now I want to take a deeper dive into the S&P 500 just so you can see what that looks like. This right here is a heat map of the S&P 500, and it shows us a number of important things. First of all, you're going to notice that there's a different size square for all of these companies, and that's because we're looking at a market value weighted index. What that means is the total market value or market capitalization of these publicly traded companies influences the amount of weight that they carry in the index. That means companies like Apple, Microsoft, Nvidia, Google, and Amazon have a much larger weight or slice of that portfolio versus the other companies here on this list. So when you invest in the S&P 500, the majority of your money is going into the biggest companies, with a smaller amount going into the smaller companies. And then within this visual here, we can see the different sectors and industries being broken down. For example, technology is the big one here at the top left, which encompasses both Microsoft and Apple. Then we have semiconductors, which is actually an industry within the sector of technology. So a sector is essentially a parent category of a broad component of the global economy. And then an industry is an individual slice or specification within that particular segment. And this gives you the benefit of having diversification built in with one investment. You don't have to go out there and buy all of these different assets and then manage them in terms of allocations, changing around the amount that you own. You can simply follow a set it and forget it approach by investing in the S&P 500 in a low-fee manner. Let me now show you how something like this has the potential to turn you into a millionaire. Back on the compound interest calculator, we're going to start filling this out, and we're going to assume that you're starting off with an initial investment here of $0 because as a teenager, you probably have a ton of time on your hands, but not a lot of money, so we're going to assume you're starting off with nothing. After that, the monthly contribution, as we said, is just going to be $50 a month or the equivalent of $600 a year. And as far as where you're deriving that money from, perhaps you're taking Christmas gifts and putting them into stocks versus taking them as gifts, or maybe you're looking to get a part-time job and allocate a small amount of money over there. I will say that as a teenager, you should focus on experiences and learning as much as possible because when you get older, you're going to want that time back. But if you are savvy and you are making money, for example, I got my first job at 15 and I was making money. I was eager to get started with adulthood and these steps like this. I would definitely push you in this direction because it's so good to get your feet wet and learn the market as a teenager. That way, when you're an adult, you have such a leg up on everyone else with this understanding that the majority of people just don't have. We're going to enter the length of time in years in a little bit, but for now, let's talk about that estimated interest rate. And for that, we need the average annual return of the S&P 500 or that heat map that I just showed you. According to Investopedia, the S&P 500 has had an average annualized return of 11.88% since 1957, so we're going to go with that figure for our calculation. And if you want to do this yourself, you can use these exact numbers and follow along just to understand the power of compound interest yourself. But we're going to start off by looking at the 10-year time horizon. So let's say, for example, you started this at age 13 and then did this from 13 to 23. Where would you be at that point in time? At the 10-year mark, you would have $10,468, which is a pretty hefty amount of money to have at 23. I would say your average 23-year-old who may be just coming out of college doesn't have $10,000 just sitting there. If we take a look here at your contributions, it's a total of $6,000 that you've trickled into the market at a rate of $50 a month, and you have about $4,400 of capital gains in terms of the money you've made from Mr. Market in that time frame. But the further ahead we go into the future, the faster and faster your wealth is going to build here because of compound interest. If we look at the 20-year mark here, a lot of people would think this account would be worth roughly double or somewhere around $21,000, but that is not how compound interest works. Let me now show you what we have at the 20-year mark by changing this right here to 20 years and clicking on calculate. Instead, we're looking at $42,634, which is actually double what you might think it would have been because of the accelerated growth rate of compound interest. The money that you're earning in terms of returns earns future returns. And it's also important to note that a strategy like this is assuming reinvestment of dividends. We talked about that at the beginning, how that's one of the ways to make money with the stock market. And when you're young, especially, this is the best time to reinvest those dividends. That way your dividends can earn future returns and also earn future dividends. But now we're going to push out even further into the future and go to the 35-year mark. And at the 35-year mark, you're looking at over $250,000. And this is from a very small amount of money being invested. We're talking about $50 every single month. The blue line here is the total contributions or the dollar value that you've invested. And the most insane part here to me is you've only invested $21,000 over that 35-year period. But despite that, because you have had time on your side and you've allowed your money to have so much time to grow, your contributions have turned into $251,000. So you've made about tenfold the amount of money that you put in terms of your 21,000 turning into over $250,000. But now let me show you how you become a millionaire with this strategy. At the 47-year mark, you'd be just shy of 1 million, and I stopped here because I want to show you something important. But first of all, at 47 years, you'd have $982,000. So assuming you started at 13, you would now be age 60, which is really not old these days if you ask most people who are 60, as the majority of people who are healthy are living well into their 80s or maybe even 90s. But nonetheless, you have $982,000 from a total dollar value of $28,200 contributed. But the crazy thing I want to show you is how much this portfolio increases in value by letting your money sit there for just one more year. So pay attention. We're at $980,000 at the 47-year mark. We're going to change this to 48 years now. And this brings us to $1.1 million. So you just made another $120,000 in 1 year following this strategy, starting off with originally $50 per month. Now, a lot of people would say they don't want to wait 50 years to become a millionaire, but what you could do is start off with that $50 a month contribution, perhaps as a teenager, and then maybe in your 20s you ramp it up, and then in your 30s you ramp it up even more to get to that goal faster by increasing your contributions over time. But the number one contributing factor to building wealth in the stock market is time. It's not about the amount that you put in, and it's not about the assets that you choose, unless you choose the wrong ones. If you choose the wrong assets, you could have a chart that goes right to the $0 line, and there's no compounding there. But as long as you are following the right approach in terms of investing in the S&P 500 or index funds in a diversified manner, you can do something exactly like this yourself. Now that you have an understanding of what investing in the S&P 500 can do for you, I want to now talk more about the index fund, as it's the investment that Warren Buffett recommends, and it's also what we've been using to demonstrate this strategy. So what we're looking at right here is the Vanguard 500 Index Fund, and this is a type of mutual fund, but instead of having a bunch of fund managers who are actively picking stocks and spending a lot of time on this, it's a very passive management because they're just looking to replicate the performance of the 500 largest publicly traded companies that we looked at earlier. So instead of having a gigantic team of fund managers, it's a very small team. You can actually click right here and get information about the fund managers. But as a result of this, you have an extremely low cost of management. Now, it's also because of the fact that Vanguard has over $7 trillion in assets under management. Because of how big they are, they can pass those savings along to you by managing such a large sum of money. However, this is not the best way to invest in index funds these days, because this is sort of an old school investment. This is a fund investment, which has a minimum here of $3,000. And if we're talking about $50 a month, it could take you 5 years to get to that minimum if you're a teenager. So you're going to need a lower barrier to entry option, and that is called the ETF, or exchange traded fund. Now, the ETF is simply taking that index fund, breaking it up into shares like we talked about earlier on, looking at what is a stock, and then allowing those individual shares to trade on the stock market. It may sound like a weird concept, but you're basically buying one share of a fund, and then that fund owns a little bit of all of those 500 companies. It collectively earns the dividends from those companies, pays it out on a quarterly basis, and then you can reinvest that dividend. Now, it's not a very high yield because of the fact that you have a decent amount of growth in this portfolio, which is companies that are still rapidly growing, and they may not be sharing their earnings with the shareholders because their priority is to grow as fast as possible. But looking at the fund here, it does have a dividend yield of 1.45%. which would be paid out on a quarterly basis. So we're talking about on $10,000, $145 per year would be what you would earn roughly in dividends. The other thing I want to point out is that the expense ratio is lower at 0.03%, making this the most efficient and cost-effective way to invest in the S&P 500. I do want to mention as well that Fidelity and Charles Schwab, as well as some other providers, do offer index funds and ETFs that will also give you exposure to the S&P 500, but I am personally partial to Vanguard just based on the fact that they were really the ones who popularized the index fund and the ETF. And I'm a big fan of John Bogle and what he has done for the entire stock market. If you want to learn more about these index funds, I just did a full video on Vanguard index funds for beginners. I'll put a card in the corner, as that's a great supplement here to this video. Over here on this page, you can see that the minimum investment is $1. That's a heck of a lot more accessible than a $3,000 minimum investment. And later on, I'm going to show you how to open a custodial account with Vanguard, and you could use that to purchase shares of VOO if you wish. Down here, we can take a look at what is actually inside of this fund, and this breaks things down by the sectors that we talked about earlier. Those were the different groups within that S&P 500 heat map, or different areas of the global economy. When you invest in the Vanguard S&P 500 ETF, 28% of your money goes into information technology, and that's because this has become such a dominant part of today's economy with companies like Microsoft, Apple, and I'm sure Google, Nvidia, and others are in that mix as well. Below that, the second biggest holding here goes into healthcare. 13% of your money goes into healthcare companies, and this is good because most of those are what's called defensive, which means they're in defensive industries that has a consistent level of spending that doesn't really vary with the underlying economy, whereas something like consumer discretionary is going to have fluctuations with consumer spending. Consumer discretionary is 10.6% of this fund. That's things that we have control of spending our money on, like travel or buying a new car, things like that. And that typically sees a decrease in spending during a bad economic time. But it's pretty cool to think about how you have built-in diversification across all of these different sectors through one investment that you can put one single dollar into. So I think it's important to know just how accessible these things are, as it wasn't like this in years prior. When I was a teenager, we were still paying for trading commissions, and there was no way you could invest a dollar into the S&P 500. Now, the last thing I'm going to show you here is the largest individual holdings of the S&P 500. As we said earlier, being a market value weighted index, the biggest companies are the biggest percentage. Looking here, 7.53% of VOO is Apple stock. That's pretty crazy. That's about 7.5 cents on every dollar. After that, 6.47% goes into Microsoft. That's pretty crazy to think that 14% of all of the money you invest into the S&P 500 goes into Apple and Microsoft. It's because the market has become so top heavy with these tech giants, but these are also the leaders of today's digital world. Below that, we have Amazon. 3% roughly of your money goes into that. Same figure for Nvidia. And then you have Alphabet, Tesla, Facebook, the other class of shares for Alphabet, as they have both a voting and non-voting class. We have Berkshire Hathaway, which is Warren Buffett's holdings company, and then United Health Group. Those are the top 10 largest slices of VOO. If we scroll down further, you can also see dividends that were paid out. So the last dividend here was $1.57. And so if you are an investor in this fund, you would earn that dividend on a quarterly basis. And if you enable dividend reinvestment, it's going to automatically go back into the issuing asset or ETF, which is what you want to do for compound interest. Now, when you invest in the stock market, you're going to want to follow a strategy known as dollar cost averaging, and this allows you to trickle your money into the stock market over time. Now, that's exactly what we were doing earlier on with the example of looking at $50 per month going into the stock market, because you'd be investing that $50 at the same routine interval with the same amount going in every single month. But the cool thing is, as the market goes up and down, which is what we're looking at right here, the chart of the S&P 500, that same $50 is going in. And when the market goes down like it did back in October, and you're putting that $50 in, you're actually getting more shares than you would get if you bought in July, for example, when we saw the market have a top. Now, that doesn't mean you want to only invest when the market is down, because it's impossible to time the market. But what you want to do is invest over time at routine intervals. And what this means is you pay the market average for those shares over time. And this makes sure that you avoid overpaying or dumping all of your money into the market at once. And it also takes all work out of the equation, because you can fully automate this strategy using today's brokerage platforms. You can use recurring investments and then automate dividend reinvestment and just trickle your money into ETFs like VOO passively without any work involved, just by setting it up once and then having the discipline to continue following the strategy. Now, as a teenager or minor, there's multiple types of financial accounts that you can open, so I did want to cover this briefly. You can also open a joint savings account or checking account in addition to having a custodial brokerage account with a parent or guardian. Now, let's say, for example, you're like me as a teenager, you get your first job at 15, you're going to need a place for direct deposit for your paycheck. In my case, I had to open up a joint account with my mom. You can do this at your local bank. It's probably easiest to do it where your parents are already banking, but you can find various options online for joint bank accounts or teen bank accounts. Capital One, for example, offers this account with no fees, no minimums. And then we have the UGMA or UTMA accounts, also referred to as custodial accounts. Now, the first thing I want to cover is the difference between these two distinctions. UGMA accounts are specific to financial assets like stocks, bonds, and cash, and this is the most popular choice. Now, UTMA accounts are not specific to financial assets, so this can include other types of assets that are then being gifted over to the child when they turn 18. So the UTMA, for example, could include real estate or artwork, which is not commonly used, but it is possible. So if you are looking to do anything like that, that is where you'd look into the UTMA classification. At this point, we're going to go through the process of opening one of these free accounts with Vanguard, and we're going to start off by clicking on the button here that says Open a Vanguard UGMA/UTMA. The first question here gives us various options for how we're getting started. If you're taking over your UGMA or UTMA account, let's say, for example, you turn 18 and you're now fully taking over that account, you would choose this option. But since we're just getting started, we're going to select Open a New Account with Money from My Bank, and then we're going to click on the Continue button. At this point, you can choose between whether you want to have Vanguard help you manage your investments or whether you want to invest on your own. I'm going to select Invest on My Own. Now, if your parent or guardian already has a Vanguard account with their 401k, or maybe they have a Roth IRA, for example, they can log in and it will pre-fill a lot of the information. But if your parent or guardian is new to Vanguard, they're going to click on the Sign Up button here. At this point, it gives you an overview of what the next steps are going to be. It's going to take about 5 to 10 minutes, as it says. And in order to open this account, your parent or guardian will need their permanent U.S. address, their employer's address, as well as their social security number. For the next step, we're going to click on Select Your Account. And this is where you're going to select the education or general investing for a minor, which gives you the option of the 529, the UGMA, UTMA, and IRAs. When you scroll down here, it now gives you the various options. So the 529 plan is for college savings. Perhaps we'll do a different video in the future on that. And if you want to see that, make sure you subscribe and hit the bell for notifications. General investing brokerage account for a minor includes both the UTMA, the Uniform Transfer to Minors Act, or UGMA, Uniform Gift to Minors Act. That's what we want to select. But if you're instead looking for a minor IRA, like for example, a Roth IRA that you're opening for a minor, you would need to have earned income to contribute to that. Whereas, for example, with these custodial accounts, you can gift money to those accounts. But nonetheless, opening a Roth IRA for a minor is another option that you have. But we want the middle option here, and then we're going to click on the Continue button. At this point, it walks us through the next steps here. The first step is to enter or verify your information. This would be your parent or guardian in this case. After that, they provide information about the minor, which may be you yourself watching at home, or you might be a parent or guardian yourself watching this video. You enter their information at this step. That way, when they turn 18 years old, the account can go into their name. And then at the very end, you're going to link your bank account and answer a few required questions related to the account. And then after that, you can buy investments once the money is in the account. And it also mentions down below that the account will transfer to the minor when they reach the age determined by the state you select. So each state has different laws surrounding this, but Vanguard will contact you 1 to 3 months before this point. So whatever the age restriction is based on the state you live in, Vanguard will give you a heads up on that, meaning reaching out to the parent or guardian saying, hey, the account is eligible or ready for transfer. But for now, we're going to click on the black continue button, and now we're going to fill in the information for the custodian, which would be the parent or guardian. So I'm going to fill in some fake information at this point. Now that we filled out the information for the custodian, we're going to click on continue, and now you provide your address and phone number for, again, the custodian, meaning the parent or guardian. At this point, you're going to verify all of the information that you've inputted thus far, and once again, these would be steps for your parent or guardian to be following themselves, and you can simply show them the instructions on how to do all of this. Now at this point, your parent or guardian is going to upload their photo ID. I'm not able to take things any further as I don't have a real ID for this fake person, but after that, and once the account is verified, they will establish what's called a successor custodian, which is going to be the minor. Now, I did want to mention taxes related to these accounts because there are some unique tax benefits that you should be aware of, and we're back over on Investopedia once again. First of all, if you gift a minor funds for the account, that is going to be exempt from taxes up to $17,000 in 2023. So that's a pretty substantial amount of money that you can just plop right in there without worrying about taxes. As far as the earnings from the account in terms of if you sell off and have a profit, for example, here's how those taxes are handled. Well, first of all, the child's income can be fully reported on the parent or guardian's tax return, so that means you're not going to have to worry about an additional tax filing for your child if you do one of these types of accounts. And then for 2023, the first $1,250 of income or earnings derived from the account would be fully tax-free, and then the next $1,250 would be taxed at the child's tax rate and passed through onto the parent's tax return, and that's going to be the lowest tax rate. So these are very tax favorable in terms of being able to have some profit taking and not worry too much, as long as it's within about $2,500 per year, and those limits go up usually every single year. So there you have it, guys. That is investing in the stock market as a teenager in a nutshell. Now, we didn't cover crypto investing and investing in individual stocks and things like that because that's really speculation and not even investing. If you do choose to do that, it is a good time to take risks while you're young, but I would recommend doing this with a very small amount of your money and perhaps following what Benjamin Graham suggests, which is doing your speculating in a completely separate account in having your investing in this other account. I definitely encourage you to start now, start while you're young, but don't go crazy trying to pile all of your money into the markets. This is going to be the lowest earnings potential years of your life, so you shouldn't be focusing on gathering all of this money to invest. You should invest if you have the means to, because you now understand the time value associated with compound interest. But as you get older and your earnings potential increases, that's when you can ramp up your contributions to your investment accounts. Now, if you are interested in increasing your earnings potential, especially as a teenager, I wrote a book called From Side Hustle to Main Hustle to Millionaire, which is a step-by-step guide on how I was able to quit my job from my digital side hustle and then build that up into becoming a millionaire by the age of 26. And this takes anyone from a complete beginner who has no idea how to make income from a side hustle to being able to make your first $100 and then scaling it up from there. It's available in person at Barnes & Noble, but you can also grab a copy at most libraries across the United States. And if you're a student at a high school, I would definitely encourage you to check with your high school's library, and if they don't have a copy, definitely request a copy because it's a really important concept for teens learning how to make money with a mini business. You can also find a copy on Amazon, or there's an author narrated version on Audible, so definitely check that out. Thanks so much for tuning in, guys. You can click below to watch my full 1-hour stock market for beginners tutorial, and I'll see you over there.